Welcome to Realty Plus Real Talk series, where we talk to industry experts for their honest opinions, views, and real facts and figures. Today, in this segment, we have with us Mr. Sharad Mittal, who's the Executive Director and CEO Real Estate Funds at Motilal Oswal Real Estate Investments. Mr. Mittal, welcome to the Realty Plus Real Talk series.
Thank you, Sapna. Thank you very much.
So first of all, I would like to congratulate you. You just, very recently closed the Indian Realty Excellence Fund 4 at a very awesome figure of more than 1,000 CR. So, and this was in middle of when the financial sector was going through a lot of crisis. So how did you achieve this?
So Sapna, I guess we need to thank our investors for the same. This is our fourth fund. We have been raising capital for over a period of last 10 years, but large part of the capital has been raised in last 6 years. And our funds have done reasonably well. So a lot of these are repeat investors. Our capital is raised domestically from HNI and family offices. I would largely give credit to the way we have gone about executing our strategy and investors' faith in us.
Okay, fantastic. So what people say that, investments are not happening or something. So that's not the reason. If you have a good background and if you have a good track record, people are ready to put their faith in
Yes.
investing with you. Great. In fact, your earlier investments, the IREF 2 and 3, they have deployed investments in mid-segment and affordable housing. So in present circumstances where a lot of delays happening and very uncertainty in the market, how are you going to manage these investments?
So if I give you a little background of what kind of investments we have done close to 55 investments over a period of last 5.5 years. And our strategy has worked where we focused largely on IT cities outside Delhi and Bombay, working with large developers, doing mid-income housing. So we don't do low-cost housing. We typically will do houses which are average around 5,000 rupees sales price. And bulk of our transactions were done at a land stage. We believe with a good developer, they will be able to get a construction finance at a competitive rate. And they probably require our kind of capital at a land stage. This is all pre-COVID. And ever since the NBFC crisis started in August 2018, we tweaked a little bit on our strategy, starting to look at projects which are more towards consolidation strategy, wherein a larger developer is acquiring a project or an asset of a weaker developer who's going out of the business. All of it is changing now. Ever since this COVID thing happened mid of March, it's been more than a month. Right now, the mindset is to take a pause. See, we are in a business of taking risk, but right now the risks are not known. How this is going to play out, there is a lot of flux in the entire industry, not only real estate, but across the board. Some pointers that we need to watch out is one, what is probably going to be the impact of this on the commercial properties, the IT space. We largely focused on IT cities. And we also need to see what happens to the larger NBFCs who have been actually in focus for last 1.5 to 2 years. And in turn, then we form a view around residential. Residential has been struggling. It's no secret over the last 3.5 years. So right now, the mindset is to wait and watch, see how things unfold. If that means that we have to wait at the fence and wait for 3-6 months, we will do that. But also the whole idea, the mindset is to take less risk and not to maximize the return. So at times what happens in situations like this, you tend to get a lot of deal flow, which looks distressed, which looks to be can generate high IRRs, but our focus is going to be reducing risk. We believe that where we are coming from in terms of COVID impact for the sector, there will be paucity of construction finance, given that what's happening with the larger lenders. Larger lenders, whether they are PSU, NBFC, and some of the other private sector banks like Yes Bank, IndusInd, and so on and so forth. So it creates a space for us to do slightly lesser risk construction finance. But having said that, this is an evolving strategy. We need to first see what is the impact of it on the overall economy and the real estate.
So is this the thinking which will also be the basis for this new fund, the IREF 4, for the
Yeah, so
strategy?
this is on the new fund. On the existing deployed, the question that you asked, how are we going to manage our existing investments? So we are focused on asset management. I think our strategy, which has worked so far for us, which is working with large developers, largely in IT cities doing mid-income housing, should held us in good steady, but it needs to be seen. So we are having a very close eye and regular interaction. You can't do too much at the site. The sites are shut. There are no workers. There are no walk-ins happening. But at least we are trying to build scenarios on the impact of this COVID. Probably in next 3 months, we will have a better idea on how our portfolio is going forward.
And you're closely monitoring all those projects where the investments have been made? You're closely monitoring how things happening
Yes,
with those
yes,
projects?
yes.
Okay. Okay. So you just mentioned the kind of developers that you have been working with. So what would be a summarization for making investments in the kind of developers or the projects that you would suggest?
So to each their own. We have our own strategy where we have executed this 50 plus transaction, where we were clear that the investors are out of the market. I'm talking about 2013-14, and that's where we got our strategy. That point of time, we felt the investors will be out of the market. The markets will be driven by end users, and bulk of the end users would like to buy in the mid-income housing. So there are a lot of home buyers in low cost, but the low cost does not have enough margins for everyone involved. We like mid segment, so we focused on mid segment. We also believe Delhi and Bombay has a lot of froth. We largely stayed out. We also were of the opinion that this business post RERA, in fact, that point of time RERA had not come, but we knew that whenever RERA comes in and the regulatory environment is set up, it will be difficult for the bottom 70% to really operate within that regulatory environment. So we chose to business with.
That's a
I think I'm not saying they're going to go out, but I think the way what was the primary drivers for having so many developers in this business? Because there were no entry barriers. It was not regulated. Liquidity was easy to come by. And I'm talking about 2002 to 12, 13. I think the entire environment has changed in the last 3 years. We had demonetization, followed by GST. Then we had RERA, which has put regulations in place. And then the liquidity crisis after a year after RERA had come. And now this business does not have the kind of profits it used to enjoy a decade back. And I think because of the regulatory environment and liquidity constraint, a lot of developers on their own probably would like to go out of this business.
Or probably have joint ventures with.
And when I say go out in an active branding perspective, you have close to 80,000 developers in India. You don't have space for so many.
Right. So lastly, what would be your three most important, you will say are the three most important factors that can help real estate to recover once we get out of the pandemic?
So there are two sources of capital or cash flow. Cash flow is the most important thing.
Okay.
Whichever way cash flow can be generated would be required over a period of next 2 years. One source is sales. So whatever can be done to get the buyers, get their confidence and do sales should be done. If it means reduction of prices, that should be done, because cash flow versus profitability, cash flow is the primary most important thing in next 2 years. The second source of cash flow is from either equity money or debt money. I think as far as the debt, because there will be debt required, this is the capital guzzling business, it would require debt support. Developers would require a construction finance. It's not possible to fund it all from the equity, which is negligible in this. By and large, very little equity has come for residential real estate. And from project cash flows, it is difficult to build the project. So there will always be a gap to fill them by construction finance and debt. I just hope that government does certain steps which allows confidence coming back of lending to real estate sector, which would, in my mind, would mean that government should do one-time restructuring of NBFC loans. NBFCs have in turn given debt to real estate developers. A one-time restructuring, the way it happened in 2008, should be allowed. It will give everyone involved to go back to drawing board and see how this debt can be unwind. And to also give confidence to some of the other lenders to come into the business. These are the two large pieces I would say going forward. And I think developer needs to keep a close eye. How quickly we go back to the sites, how with what agility we start the sales. Because this pandemic, it's not like a war which is getting over in 3 months.
Right.
It's here to stay. We need to understand that we need to live with it. Hopefully we get a vaccine and it all goes away or the intensity comes off. But this is not going away in 3 months. So we need to tweak our internal processes, systems to see that we live with it and come out winners.
Okay, so very crisp points that you one mentioned, that developers should not shy away of cutting the prices, dropping down their sales prices if they want the cash flow. Cash flow is the king. And second is restructuring of NBFC loans. That is very important if you want funds for confidence of fund people to come in. And lastly, we have to reinvent and reimagine to live with new normal, because as you said, we still are in an uncertain period how things are going to happen even if we come out of the lockdown. Thank you so much, Mr. Mittal. Those were very valuable inputs, and I'm sure our the viewers will be benefiting from these suggestions that you made. Thank you so much. It was a pleasure
Thank you,
to have
Sapna.
you here
Pleasure
with
talking.
us, and wish you all the best.
Wish you all the best too. Thank you so much.
Thank you.